Hi clients and friends, Mike Brady here. This week I want to talk about tax efficiency. We're now in tax time. You're either done completing your taxes, good job for you, you're doing it right now, or maybe you're blowing it off to later, but that being said, April 15th is right around the corner. And this is very relevant to our investments because our investments have taxable consequences. In a perfect world, that's not the case. But you know what? We don't live in a perfect world. And so therefore, taxes are a part of our investment strategy. Not a week goes by that a client says to me, gosh, I'd love to make an extra 0.5% there, or 2% there, or whatever it might be, but yet don't bring up the most obvious, which is the biggest single expense that most people have are taxes, and therefore, how can we minimize the tax bite into our investments? Well, there's 2 or 3 things that just kind of come to mind. One is taking careful look at the short-term and the long-term capital gains. The long-term capital gains can be from 0 all the way up to 15%, depending on what your tax bracket is. Ensure that you can have long-term capital gains, but it's not a hardcore rule. In order to save a little bit of taxes, you're going to leave yourself exposed? Of course not. So therefore, if something really bad is happening throughout the year and you want to move the assets over, maybe paying some short-term capital gains at ordinary income rates is the way to go, but this is an important decision. Do you, what can you do to still kind of keep the capital preservation, but have it at more preferential long-term capital gains? Another thing is, what's your exposure if you've got ETFs or ETNs? Should you be in an ETN? You heard me back in August talk about ETNs, exchange traded notes, and how they're a promissory note from the bank. Well, one nice thing about ETNs is that it's really just short-term or long-term capital gains about when you sell. There's no distributions through interest or dividends or pass-through. But of course, you've got to make sure that the bank that's issuing that promissory note has a good balance sheet. So there is that maybe principal or counterparty risk that you've got to take into consideration. Of course, the Roth and the traditional IRA as a part of your portfolio is another tax strategy. If you've got both of them and you need income for the year, do you take from the Roth, which is income tax free, or do you take from the traditional IRA? So much focus is put on rates of return, but not as much consideration put into how can we be tax efficient in the investments that we own. If we have to sell them, do we sell them at a short-term or long-term capital gain? And do we have the right distribution methodology for supplementing our other sources of income from our investments? Are we taking it from taxable or non-taxable? Are we taking it from Roth IRAs, traditional IRAs, etc.? So I guess my big advice for this week is to really focus on the tax efficiency of your strategy, and hopefully you have that strategy. My name is Mike Brady. I'm with Generosity Wealth Management. I'm a registered rep with QA3 Financial. 303-747-6455. You have a wonderful week. Thanks. Bye-bye.